You own shares of a stock. They're sitting in your account, and while you wait for the next move, they're doing nothing for you. What if those shares could pay you every single month just for holding them? That's what a covered call does, and it's one of the oldest, most reliable income strategies in the market. Let's walk through it. A covered call is simple. You own at least 100 shares of a stock, and you sell a call option against those shares. That call option gives someone else the right to buy your shares at a specific price, the strike price, by a specific date. In exchange, you collect a premium, cash in your pocket immediately. It's called covered because you already own the shares. If the buyer exercises their right, you can deliver the stock. There's no naked risk here. Think of it like renting out a property you own. You still hold the asset. Someone pays you for the right to use it under certain conditions. And if those conditions are never met, you keep the rent and the property. Let's walk through an example. You own 100 shares of a stock, trading at 55. You're fine holding it, but you don't expect a massive move in the next month. You sell one call option with a $60 strike, expiring in 30 days. The market pays you $1 per share. That's $100 in premium. Now there are three outcomes. Outcome 1, the stock stays below $60. The call expires worthless. You keep the $100, you keep your shares, and you can sell another call next month. This is the ideal scenario for most covered call sellers. Outcome 2, the stock rises above 60. Your shares get called away at 60. You still keep the $100 premium, plus you capture the gain from $55 to $60. That's $500 in stock appreciation. Your total return is $600 on a $5,500 position. Not bad for 30 days. Outcome 3, the stock drops. You keep the $100 premium, which cushions the loss slightly. If the stock falls to $52, your unrealized loss is $300, but the premium offsets it to $200. The covered call doesn't protect you from a big decline, but it softens the blow. The strike price you choose is the single most important decision in a covered call. A lower strike, closer to the current price, gives you more premium but a higher chance of your shares being called away. This is an aggressive approach. You're prioritizing income over holding the stock. A higher strike, further from the current price, gives you less premium but more room for the stock to appreciate before it gets called. This is a conservative approach. You're prioritizing long-term ownership. For most income-focused traders, a strike around the 0.20 delta is a solid starting point. That means there's roughly a 20% probability the option expires in the money. It's far enough out to give the stock room to breathe, but close enough to collect meaningful premium. If you're holding a stock for long-term growth, maybe it's a core position you don't want to lose. Lean toward an even lower delta, like 0.10 to 0.15. The premium will be smaller, but you're much less likely to have your shares called away. And if you're in a stock you'd actually like to exit at a profit, sell the call closer to the money. If you get assigned, great, you sold at a price you were happy with and collected premium on top. Here's something many traders overlook. Covered calls can have tax implications, especially if you're holding shares for the long-term capital gains rate. If you sell an in-the-money or deep-in-the-money covered call, it may reset the holding period on your shares. That could turn what would have been a long-term gain into a short-term gain, which is taxed at a higher rate. The safest approach for tax-sensitive positions is to sell out-of-the-money calls, strikes above the current stock price. These generally don't affect your holding period, but this is an area where it's worth consulting a tax professional to understand the specifics of your situation. If you've been following this series, you already know about cash-secured puts, and here's where things come together beautifully. The wheel strategy is the combination of selling cash-secured puts and covered calls in a continuous cycle. Phase 1, you sell a cash-secured put on a stock you want to own. If you're assigned, you buy the shares at your chosen price. Phase 2, you sell covered calls on the shares you now own. You collect premium while you hold. If your shares get called away, you go back to phase 1. Sell another put, collect premium, and wait. It's a loop. And at every stage, you're collecting income. The wheel works best in sideways to moderately bullish markets, on stocks with solid fundamentals and decent option liquidity. Let me flag a few things to avoid. Don't sell covered calls right before earnings unless you're prepared for assignment. A surprise move can push the stock well past your strike, and you'll miss the upside. Don't sell calls so close to the money that you get called away on a normal fluctuation. Give yourself room. Don't ignore the cost basis. If you're assigned shares through a put at $45 and you sell a call at $47, make sure that's actually a price you'd be content selling at after accounting for commissions and your effective entry. And don't get greedy with expiration dates. Selling calls 30 to 45 days out gives you the best theta decay curve. Going further out ties up your shares for longer with diminishing returns. Covered calls are about making your shares work for you while you wait. You collect premium, reduce your cost basis, and create a disciplined framework for managing positions. Choose your strikes based on your goals, income versus growth, and use the 0.20 delta as a starting point. Be mindful of taxes on long-term holdings. And if you're using the wheel strategy, covered calls are the second half of a powerful income cycle. Simple, methodical, repeatable, that's the theme. Subscribe if this series is helping you think differently about the market. More strategies ahead. See you in the next one.